All right, let's dive right in. If you've ever bought something online from another country, or maybe even just planned a trip abroad, you have personally stepped into the massive, interconnected world of international economics. Today, we're going to pull back the curtain on how all that money moves around. We'll look at how currencies get their prices and how entire countries keep a sort of financial diary of their dealings with the rest of the globe.
Now, I want you to know that this whole explainer is built directly from some excellent revision notes prepared by Mr. Tommy PC for his 12th grade students. He's been teaching economics for the past 3 years, and this is really a shout out to the hard work he and his class are putting in. So, a big hello to all of you.
So, let's start with a really simple question. When you buy a phone that was made somewhere else, or watch a movie produced overseas, what's actually going on behind the scenes? There's this huge economic machine whirring away. Where does your money really go? And how does their money find its way here? That is exactly what we are going to break down.
So, here's our game plan. We'll kick things off with the basics, what an exchange rate even is. Then we'll see how those prices get set. After that, we'll zoom out and look at how a nation tracks all this financial activity. We'll break down the main accounts they use, and then, of course, we'll wrap up with the key takeaways you'll want to remember. Sound good? Let's get to it.
Okay, first things first. We have to get our terms straight. Before we can really talk about global trade, we have to understand its most fundamental building block, the exchange rate.
And even before we get to the rate, let's define foreign exchange itself. It's actually really simple. It's just the collection of all foreign currencies that a country has. So for a country like India, any currency that isn't the Indian rupee, think US dollars, euros, Japanese yen, that's all considered foreign exchange.
And that leads us perfectly to the foreign exchange rate. This is just the price of one currency in terms of another. So if it takes, say, 58 rupees to buy one single US dollar, well, the exchange rate is 58. It's basically the price tag for buying another country's money.
So, who decides on that price tag? Is it a government committee somewhere, or is it just the market? Well, the answer is, it depends. Let's look at the two main systems countries use to figure out what their currency is worth.
This table lays out the two big ideas really clearly. On one side, you've got the fixed exchange rate system. This is where the government steps in and says, this is the price. They do it to create stability, to make things predictable for businesses. On the other side, you've got the flexible system, where the price is set by the good old forces of supply and demand. It's a bit more chaotic, but it reflects the real-time market.
Let's make this a little more interactive. I've got a question here for Danushri and Mohammed. When we think about that flexible, market-driven system, why do we as a country even need foreign currency? What are some of the big reasons that create a demand for it?
You're totally on the right track. The demand for foreign currency comes from all kinds of places. We need it to pay for things we import, right? And when we travel to other countries as tourists, we need their money. Same goes for sending money to family overseas, or even for bigger things like buying property or stocks in another country.
And this graph shows us exactly how that demand works. I mean, this is straight out of Economics 101, isn't it? Price matters. As the exchange rate, that's the price on the vertical axis, goes up, that foreign currency gets more expensive for us. So what do? We demand less of it, which you can see on the horizontal axis. And that gives us this classic downward sloping demand curve. Simple as that.
Okay, so that's the demand side. But where does this supply of foreign currency come from? Well, it's pretty much the mirror image. It comes from our exports, right? When foreigners buy our stuff. It comes from tourism, when visitors come here and spend their money. And it comes from foreign investment, when companies or people from other countries buy assets here. All of these things cause foreign currency to flow in.
And here's the supply curve to prove it. The logic here is pretty direct. When the exchange rate is high, it means our currency is relatively cheap for foreigners. That makes our exports look like a really good deal to them. So they buy more from us, and as a result, the supply of their currency flowing into our economy goes up. This gives us that classic upward-sloping supply curve.
Right, so this brings us to a really important point. We need to be specific about what we call it when a currency's value falls. This table clears up a key distinction. Depreciation is what happens in a flexible system. It's the market, supply and demand, pushing the value down. Devaluation, on the other hand, is a conscious, deliberate choice by a government in a fixed-rate system to officially lower its currency's value. Same result, but totally different reasons behind it.
Okay, let's zoom out for a second. We've been talking about individual transactions, but how does a country keep track of, well, everything? All the exports, the imports, the investments, all of it, every single day.
Well, they do it with what I like to call a national financial diary.
And the official name for this diary is the Balance of Payments, or BOP for short. It's a systematic record of literally every economic transaction between the people of one country and the rest of the world over a certain amount of time, usually a year. It's the ultimate financial scorecard for a nation's global dealings.
Now, you've probably also heard the term balance of trade, or BOT. This slide is perfect for clearing up any confusion between the two. The balance of trade is just one part of the balance of payments. See, the BOT only looks at visible things, physical goods being shipped in and out. The BOP is way bigger. It includes goods, services, transfers, capital, the whole shebang. Think of it this way. The BOT is one chapter, the BOP is the entire book.
So, how is this financial diary, the balance of payments, actually organized? It's split into two main sections or accounts that track different kinds of money movements.
Just think of it like this. You've got the main BOP ledger, and it branches out into two big sub-accounts. You've got the current account, and you've got the capital account. Every single international transaction gets filed into one of these two.
All right, time for another question. This one's for Ashmitha and Asifa. Let's imagine someone in India gets a monetary gift from a relative living in another country. It's a one-way transfer, right? Money just comes in. So in which of those two accounts, current or capital, do you think that transaction gets recorded?
Let's find out. This table has the answer. The key difference really comes down to flow versus stock. The current account tracks flows, things like trading goods, services, and one-way transfers, like that gift. The capital account, on the other hand, tracks changes in the stock of assets and liabilities, like buying a factory or taking out a loan. So that gift from a relative, it's a flow, so it goes right into the current account. Nicely done.
Whew, we have covered a lot of ground here. So let's slow down, bring it all back together, and really focus on the essential points you'll want to take away from all this.
So, let's put it all together. It all starts with the exchange rate. That's just the price of a currency. In a flexible system, that price is always moving, pushed and pulled by supply and demand. Every one of those transactions gets logged in the balance of payments, which itself is split into two big parts: the current account for the day-to-day flow of goods, services, and transfers, and the capital account for the long-term buying and selling of assets. You see? It's all one big, interconnected system.
And that's our look at foreign exchange and the balance of payments. Getting a good grip on these ideas is absolutely your key to understanding how our global economy really ticks. I want to give a huge final thank you to Mr. Tommy PC for his fantastic notes that made this all possible, and of course to his students, Janani, Pujana Priya, Rishi, Danushri, Mohammed, Ashmitha, and Asifa for inspiring this whole explainer. Keep up the great work and keep asking those great questions.